So you had this recent comment from Bank of America recently. I'm going to share the screen here in a second. Let's go ahead and read this quote. It says here, soon all commodity charts will look like gold. This is from Bank of America's HeartNet, and he's going bullish on commodities. So it says, so the summary is Bank of America chief investment strategist Michael Hartnett thinks that oil and energy stocks are the best contrarian bet for 2026. He also says that the Trump administration's run it hot policy will see commodities boom and outpace bonds next year. He regards despised oil and energy sector as the best contrarian trade out there. Would you agree with that? Do you see us being on the cusp of a big commodities trade here?
Yes, I agree with that. And that's how people will see it, is that stuff, real stuff, is going to go up in price, but it's not really the real stuff going up in price. What it is, it's the currency itself losing purchasing power.
Yeah.
Another word for that would be inflation.
I mean, it sounds like massive inflation is on our doorstep.
Right.
Speaking of which, let's go ahead and pivot over to gold. But before we do that, one last look at these silver charts here. Looking at it from an overbought, oversold point of view, we are getting into overbought territory. According to, in relative terms, the last time we hit these levels around this red line here was back in October, between late August to October, and that was kind of like the local top there in silver. Interestingly enough, however, when you look at gold, gold is fairly neutral. It's a little bit elevated, but nowhere near as much as heated up as silver is. I'm going to take a look at the gold chart here. Yeah, gold's been moving sideways, whereas silver's been making new all-time highs. Is gold a more opportunistic play in your eyes now, Mr. Gold, or how does gold fit into the analysis?
Play is still silver. Yeah, the play is still silver. Just from a fundamental standpoint, it looks like there are absolute shortages on the various exchanges. A gold to silver ratio of 70-1 is still extremely high. It only silver comes out of the ground 1 compared to gold. And man discounted for hundreds of years that 10-1 ratio to 16-1 because they had to carry 10 times more silver to equal the same amount of money in a cart or on a mule or what have you. Then we got into the 80s and 90s with financialization, and that allowed naked short contracts to price the metals, and silver was easier to price than gold because it's a much smaller market. You need less money to affect the price, and that's what they've done for years, is suppress the price. But no, I still think the play going forward from here is definitely silver. You want to be overweight silver, because we're probably going to get down to the 15, 20, 25-1 ratio. From here, from where it is here, you'd still have silver outperforming by 2 or even 3 times the gold price. So keep concentrating on silver. There's blood in the water now.
Yeah. And gold's no slouch either. You know, you look back at these yearly charts, we're up 58% on the year so far here in gold. And as we can see here, I mean, that's the biggest year we've had in 20 plus years. You go ahead and look at the seasonality. Gold's well above seasonality relative to its 5-year and 25-year average. Let's just slap on the 30-year average as well. It's well above that too. So, I mean, both metals are moving in tandem. You really can't go wrong with either one, but definitely silver has that added torque. If you want that added torque involved in your metals trade, it seems like silver's the way to go. Let's go ahead and take a look at the projections here. Looking into 2026, both bull and bear base scenarios have it, hitting at around heading close to $5,000 by, what is that, February, end of February, according to this modeling tool. So
I don't know what they put into that.
Yeah, but
I don't know what they put into that to get those answers.
Yeah, it just looks at past data and calculate. It's kind of like an AI model. Looks at all the data in the past and tries to fit this pattern with the pattern that we've seen in the past and extrapolate out the forecast. But be that as it may,
Yeah, Denny,
go ahead.
what you just mentioned, gold being up 58%. Again, an ounce of gold today is what an ounce of gold was a year ago, 100 years ago, and 1,000 years ago. The ounce of gold doesn't change. What changed is the value, the purchasing power of currencies. And what that shows you, if gold's up 50%, that shows, I'd have to do the math, but what is it, a 30, 35% drop in purchasing power of currencies in order for gold to go, from 3,000 to or just under 3,000 to a little over 4,000. Gold did not go up. That ounce of gold is still the same ounce of gold. What went down is the purchasing power of your dollars, your euros, your yen, what have you.
Yeah, that's really what it is, especially in the case of gold. I've been asking this question to my guests who I've been having on this month. Bill, I don't know if we're going to be able to talk for the remainder of the year. This is probably going to be our last interview for the calendar year. So I want to pose this to you, and that is, if you could make 3 big predictions for 2026, looking ahead for the new year ahead, what would those 3 predictions be?
There will be massive volatility in all markets. I think that's going to be a given. Is that volatility has got nowhere to go but up. Volatility, they've tamped it down. If you look at the VIX and the other volatility indexes, they're relatively low. And I think what we're going to have next year will be volatility. I also think next year will be the year that the BRICS really come forth with their unit. And that, obviously that's going to create volatility in currency markets. But the world is thirsting for a currency that they can trust. Because right now, the world's reserve currency is the dollar, and you can't trust the dollar. My third prediction would be that we're gonna get some real information in many areas, I think, this coming year. And I think a good deal of that information is going to point to, you've been lied to for all these years. And I think that will also add to the volatility, because if people are finding out that, they were investing without real information or full information, you're going to have some minds changing, and some, obviously, the thought processes behind investors are going to change. So I think that's what you're going to see, is you're going to see more volatility. And I do think we're going to get some real information this coming year that a year ago, 5 years ago, 10 years ago, we would have thought that, it's crazy to think that the type of information that's going to come out. And it's not just financial. I think 2026 is going to be the year of truth. I hope.
That seems to be being the trend. Ever since 2020, there seems to be a trend towards the truth. And as every year rolls on by, we get closer and closer to learning more about how much we've been lied to. And of course, gold and silver is at the heart of it. It's at the heart of Exeter's pyramid. And all money derives from gold.
Well, gold and silver are truth when it comes to money. A bar, a coin, what have you, is proof positive that labor, cattle, and equipment have already been used to create that coin. It's proof positive that you have value, you have wealth in your hand. You don't have to trust. The word trust me is not involved, because an ounce of gold or an ounce of silver, as long as it's pure, there's your trust right there. You don't have to have any trust, because you have the knowledge that you have gold or you have silver, and gold and silver are money. I think people are going to start to figure that out also, is that, you got $1 million in the bank, but poof, by the end of the year, what happened to the purchasing power? What does it buy you after a year, 2 years, 5 years?
Yeah. Let's just really quick here before we wrap things up. I want to look at the silver miners. Excuse me. Yeah, silver miners it looks like they're making this double top. We'll see if it breaks through. But silver miners are up. If you thought silver was up, silver miners are up 139% so far this year. And from a historical perspective,
which is actually lagging.
Yeah. Yep. Because
that's lagging the price of silver.
Mm-hmm. Yeah, because the price of silver is at an all-time high. SIL is still at the same level as the previous top in October.
Yeah, the rule of thumb has always been that miners move roughly 3 times, both upward and downward, whatever the metal moves. If the metal moves 10% in either direction, the miners are going to move 25, 30% in both gold and silver. So the fact that silver's up 105% and the miners are up 139%, that tells you that the miners are definitely still lagging the metal itself.
What does that mean when the miners lag?
It could be, not belief in the move. It could be people assessing jurisdictional risk and either not getting in or bailing out of positions they have. So yeah, if the miners are lagging, it shows you skepticism on the side of mining share investors.
Well, here's another interesting tidbit. Here's GDX, the gold miners index, and you'll notice that it's up similarly. It's up 134% this year, pretty much the same level as SIL, the silver miners index. However, the GDX appears to have a lot more torque relative to gold than silver does, and then the silver miners have relative to silver. As you recall, gold's up 58% this year. GDX is up 134%. SIL is up 139% this year, but silver's up 100%. So there's a mismatch here between the gold miners and the silver miners. Does that imply that there's more opportunity present in the silver miners?
Well, there is more opportunity in the silver miners, but there is more risk. I mean, as a point of fact, Mexico is talking about changing their mining laws. They're not allowing new prospective zones or leases, and I think you've got investors worried about what's happening in Mexico. And Mexico's obviously important to silver miners because I think it's the biggest producer of silver worldwide.
Yeah.
So it could be that it could be just fear of the jurisdictional risk.
Mm-hmm. It's interesting because fear of the greater the risk is on the silver miners, you would think that the greater the reward is on the price of silver, because that provides a headwind against greater supply coming on the market if they can't mine this stuff as efficiently as they would like to.
Yeah, I mean, they're gold miners and silver miners. They are in the business of minting money.
Mm-hmm.